LKAS 2 inventories. Uh, in the previous session, we have discussed about introductory part of this standard, and also we have discussed how to measure the cost, how to measure the cost of inventories. And the cost of inventories, there are three components. The first part is cost of purchase, which includes uh, the cost arises the time of purchase the inventory and bring the inventory to the intended locations and intended state. So that's what we have already discussed. And the second part, that's what we are going to discuss today's session. So the cost of conversion mean what? Organizations, entities purchase raw material, and they wanted to convert this raw material into finished goods. Raw material into finished goods. So during the conversion process, uh, wage will be paid to the laborers, and other overhead costs will be incurred for the conversion process, and other relevant cost may occurs, right? The, during the conversion process, that is convert raw material into finished goods, right? So in the cost of conversion, it has two kind of cost: direct conversion cost. So direct labor, direct material, royalties. So these are the directly traceable cost, right? And indirect overhead cost. Overhead cost. So this can be divided further by two: fixed production overhead, so plant depreciation, factory rent, factory supervisor, and related to that. So here, allocated to inventories based on normal production level. Right? It's very important, the normal production level. So we will discuss in detail the exact meaning of normal production level. So this normal production level is appropriate when absorbing the fixed production of head cost to particular units. When we deal with variable production overheads, say for example, indirect raw material like grease, oil, like that, and indirect wages like supervisor salary, rent, like that. Suppose not supervisor salary, so polishing, like that, right? Variable production overhead. So it's kind of what indirect raw material, uh, indirect wages, sorry, right, etc. So here allocated to inventories based on actual production level, right? Here actual production level, that is important, and you may get clear idea on what is normal production level and actual production level when we do some calculations. So, and also we have to discuss on other cost. So here, a specific pattern and designing expenses, architecture fees, and so that developing piece of the product. Now, our focus on mainly here, right? So this part, these sections we are going to cover today. Right, it has been already discussed cost of inventories, that is a cost of purchase. We have done this sum. Right, yes, we have done. Now we discuss from this cost of conversion. In case some inventories that are subject to some form of production or conversion process, so there would be a cost attached attributable to the process of converting the raw material into finished goods. So the cost of conversion of inventories include direct cost and overhead cost. Direct cost directly related to the unit of production, such as direct labor, direct material, direct expenses. So it can be easily traceable throughout the production process. And the overhead, so they also include a systematic allocation of fixed and variable production overheads. So there are two types of overheads here, a fixed overhead and variable production overheads that are incurred in converting raw material into finished goods. Right. Now we'll see what's the treatment for fixed production overheads. So fixed production overheads, this fixed production overheads are not varies based on the number of productions, number of units produced, right? So it's regardless the number of units it has incurred, right? So up to a certain level of production capacity. So the fixed production overheads are those indirect costs of production that remain relatively constant, right? It not varies over the time or over the number of unit product produced, regardless of volume of production, such as depreciation, maintenance of factory buildings and equipment, and the cost of factory management and administration. So these costs are not varies according to the number of units, that is a volume of production. Variable production overheads are those indirect costs of production that vary directly or, or nearly directly with the volume of production, such as indirect material and direct labor. Here, because the systematic allocation of fixed overhead. Now, our focus on the fixed overhead. Systematic allocation of fixed overhead. How to allocate, how to distribute the fixed overhead cost into production units, So you may study different types of costing method, right? Absorption costing, marginal costing, ABC costing, like that. But here our focus is different scenario. So the allocation of fixed production overhead to the cost of conversion is based on normal capacity. So keep in mind, so we have to consider normal capacity of the production facilities. What do you mean by normal capacity of production facilities? Normal capacity is the production expected to be achieved on average over number of period or sessions under normal circumstances, taking into account the loss of capacity resulting from plant maintenance, right? So for example, you purchase a photocopier, right? A photocopier. So, and the photocopier has its toner. From this toner, you can take printout, or you can get copies 10,000. You can get number of copies equal to 10,000. So what is the normal capacity of that photocopier? What's the normal capacity? Any answers? What's the normal capacity of that photocopier? A toner, a photocopier consists a toner. Uh, it can be used to take 10,000 copies. Then what is the normal capacity of that photocopier? Toner capacity 10,000, but actual production is 7,000 or 12,000. So in that time, the actual production is 7,000 or 12,000, right? The actual level of production may be used if it is approximates normal capacity. The amount of fixed overhead allocated to each unit of production is not increased as consequences of low production or idle plant. So again, I ask one question regarding the same scenario. The cost of the toner is 10,000. Cost of the toner is 10,000, and it has printed only 7,000 prints. So after that, the toner has finished. So this time how much the cost of not 7,000, 5,000 for your easiness of calculation. So how much now cost per print? Any answer? Cost of the toner is 10,000, but actual production is 5,000 units prints. Then how much cost per overhead cost per print? How much? Any answer?
0.5.
2.5.
0.5.
2 rupees now. 10,000. The price of the toner 10,000. You able to take print 5,000 units.
Okay.
Then how much?
2 rupees.
2
2
rupees.
rupees.
So if you give the answer in this way, you are incorrect. The answer is incorrect. Right? The answer is incorrect. Your calculation is right, but your answer is incorrect. So that's why I'm going to emphasize these slides, these term words. Right? Say for example, right, keep in your mind this answer, right? Your answer is incorrect. I will explain why. So, we are dealing with LKAS. We have to follow the rules of LKAS. Right. Here, right. Unallocated overheads. Unallocated overheads. Sometimes we call under absorption. So you might study it in cost accounting or management accounting. Allocated or unallocated overheads under absorption are recognized as an expense in the period in which they are incurred. In period of abnormally high production, the amount of fixed overhead allocated to each unit of production is decreased so that inventories are not measured above the cost. So this scenario, as I told you, the toner capacity is 10,000, but the actual production is 5,000. So this time is what under so abnormally lower production, right? Abnormally lower production. That time, right? That time the treatment is different. That's mean what? When we allocate the cost, when we allocate the fixed cost to the production units, we have to use normal capacity. Normal capacity. Say for example, uh, the photocopier, the cost of photocopier is 10,000. So it's expected normal capacity is 10,000 units. So therefore, absorption cost how much? Absorption per unit is 1 rupees. Absorption is 1 rupees. Anyhow, the actual production is equal to 5,000. In that scenario, even though the actual production is lower than the actual normal capacity, we have to absorb the fixed cost based on the based on the normal capacity. So then for 5,000 output, for each unit cost 1 rupees. So 1 rupees into 5,000, 5,000 rupees is the fixed cost. And the balance 5,000 it belongs to, it will be the balance 5,000 will be transferred to the PL account as loss, as expense, right? As expense. But in case of abnormally high production, say expected normal capacity is 10,000, but it prints 12,000 prints. It prints 12,000 units. Now the expected 10,000, but actually is 12,000. Now, when we calculate the cost of fixed cost of a print, 10,000 is the cost, fixed cost divided by actual number of units. How much actual number of units? 12,000. This time, that is the cost per fixed fixed cost per print. So that is in practice. When production equals to normal capacity, or if actual production is greater than its business, production overheads are absorbed based on the actual production capacity, right? Based on the actual production capacity, unless there is an over absorption of production overheads, right? Here it's very simple, right? So that slides, the LKS has been simplified in this graphical format. So number of units produced. If number of units produced is low, it's a low production or idle plant. So for example, the expected capacity, normal capacity is 10,000 we expected, but the actual production is 5,000. So in that case, it falls in this category. So in that time, so absorption, how to calculate? Absorption based on normal capacity. What's the normal capacity? 10,000. And cost of the how much fixed cost? 10,000 rupees. Then 10,000 rupees divided by 10,000 equal 1 rupees. Right? Balance 5,000 will be charged in the income statement as expense. Right? So in case of, right, the number of unit produced is approximates normal capacity. So for example, 10,000 expected, it produced 10,000, or it produced 9,900, 9,800, or 9,200, like that. Or so 10,200, like that. So it's been approximate 10,000. So that time our basis is absorption on the basis of based on actual capacity, based on their actual capacity, right? And also same thing applies abnormally high production. Here expected 10,000, but actual production is 12,000 print, 12,000 print. So that time also we have to use the same formula. Allocation based on allocation should be based on actual capacity. Make sense? Clear? Is it clear? Now we move to the calculations, right? If you unmute your mic and if you are interact with me, I will go slowly. Otherwise, if nobody not open their mouth, then I will go in express mode, right? Right, this is the question. So budgeted production overhead is 1.3 million. Budgeted fixed production overhead 1.3 million. Fixed production overhead is 1.2 million. Actual production 3,000. Normal production 4,000. Budgeted production 6,000. Compute the production overhead absorption rate. Compute the production absorption rate. So how to calculate? They're asking about how much per unit fixed cost. How much per unit fixed cost? How much? So here they have given us information about fixed cost. This is the actual fixed cost is 1.2 million. Actual fixed cost is 1.2 million. Budget fixed overhead 1.3 million. Budgeted production 600,000. Normal production 400,000. Actual production 300,000. Here, what's the answer? So here, what's the normal capacity of this machine? Normal capacity?
400,000
Very
units.
good. Actual production 300,000.
300,000.
Yeah, here actual production is lower than normal capacity or equal or higher.
Actually, it's lower than normal
Very
capacity.
good. Then what formula we have to utilize?
We have to select 300,000 units.
Right. 1.2 million divided by?
300,000 units.
No, answer is wrong. Any other answer?
Sir, no, we have to absorption on normal capacity. So
Yeah.
400,000 units.
Yeah, 400,000. Here fixed cost is 1.2 million and it should be divided by 400,000 units. Then per unit overhead cost how much?
3.
How much? 3 rupees. 3 rupees per unit. Then how much total production total fixed cost should be allocated for the production cost. Three units per three rupees per unit, and number of production 300,000. Then how much? 900,000 will be charged. 900,000 will be charged, allocated for the cost of the production. Cost of the production, for the cost of production. Balance 3 million will goes to where? Balance 300,000.
P&L account.
P&L account as a expenses, as a expense. Clear? Right. We move to second one. Here, fixed production overhead, actual one 1.2 million, actual production 500,000, normal production 400,000, budgeted 600,000. Compute fixed production overhead absorption rate. Here, so we don't worry about budget production, and here normal production 400, actual production 500. So here, so the actual production is above or below the normal capacity.
Above the normal capacity.
Very good. Then, so what is the basis? We have to divide 1.2 million by how many units?
500 units.
Very good. Very good. 500 units. Sorry, 500,000 units. Then now you can observe the fixed overhead cost will be reduced. Fixed overhead cost per unit will be reduced. So earlier, so if you calculate based on the normal production, the absorption rate was 1.2 million divided by 400,000 equal to it's equal to 3 rupees per unit. But now the actual production is higher, then you can expect that per unit fixed cost will be reduced, right? So this time the total total fixed overhead 1.2 million will be charged will be charged for production cost. There is no loss or no gain here, right? Right. Variable cost, fixed variable overhead cost, right? Variable overhead cost, variable production overhead cost. So variable production overheads are allocated to each unit of production on the basis of actual production level, right? Here, actual production level or actual use of the production facilities. Variable. So overheads that are arising from other functions of business are not allocated for the inventories, right? For example, here we have to consider only the overhead, variable overhead arises in the production process. Other function like advertisement and advertisement, admin expenses, that charges, that expenses cannot be included in the cost of conversion of inventories. Here, this is here one example. Please look at this example, and I give you 5 minutes. You please work out on this. So please do yourself, otherwise you couldn't understand. First, do by yourself. Actual production or actual sales? Yeah, 76,000. Why all of you are silent? Sales, no? Sales for the year. Sales for the year 76,000. 1/6 of actual production remained at closing stock at the end of each year. Here total production equal, right? Total production equal sales plus closing stock. If there is any opening stock, we have to deduct. Right? In this scenario, there is no information about opening stock. Right? We know sales. How much sales?
Sales is 76,000 is fifth sixth.
Yes.
We have to take sales the fifth sixth and closing stock is 1/6 of
Yes.
total we have to take.
Definitely. This 76,000. Right? No, I put here. This 76,000 equal to 5/6, isn't it? 5/6. So this is equal to 5, and we need 6. So total production is 91,200. Closing stock equal 1/6 of this. 1/6 of this. 15,200. Or you can find in the other way around. 1/6, no, divided by 6. You will get same answer. Got clear? What the idea? So actual production is 91,200. What the answer? Now it is, so what is the base? We have to take normal capacity or actual production. Here we have to take for absorption. Absorption, we have to take, we have to divide this 400,000 by 100,000 or 91,200. Which value?
100,000.
Very good, because the actual production is below than normal capacity. So therefore, fixed overhead per unit equal 400,000 divided by 100,000 equal 4. Equal 4. Right. Then how much fixed overhead here?
91,200 into 4.
Very good. Very good. Good. So per unit is 4 into actual production is 91,200. This how much? 36,000. So 364,800. Then total production cost. Total production cost equal this value. How much closing stock? Value of closing stock. Now we can find total cost per unit. Total cost per unit equal, this is total cost. Total production equal 92,000, 91,200. Right? Then closing stock. How much? Equal, we have closing stock, how many units? 15,200 into cost per unit. And how much? Closing stock, this value, right? Right. Got the answer? Clear? Got the point?
Yes, clear.
All right.
Yes, sir.
Right. Now we move to the second slide. Illustration 7. I hope you can do it. Right. I give you 261,000 and direct production overhead. Other production overhead 68,000 and variable production overhead variable production overhead, that is 325. Same question, no? Same as earlier. Then fixed production overhead, fixed production. Now, fixed production overhead. How much fixed production overhead? It's 400,000. And closing stock. Closing stock 176. It's a balance sheet value, no? It's a cost. And sales for the year 3.8 million selling price. Then sales, right? Cost of sales. We have to find cost of sales and sales. Sales per unit 50. Quantity, how many units we could find? Then sales value equal 3.8 million. Then how much? How many units sales? $76,000 units of sales, right? The actual production for the year was 87 of the normal capacity, right? The actual production of the year was 87% of normal capacity. Assuming that there were no opening inventory and no write down, we are required to compute actual production units. So how do we find the actual production units? So that's a tricky, and there's a clue to find. There's a clue to find, right? So I will work out on this. So now we have to take 87% of the normal capacity, no? So what's the absorption? So the fixed cost is equal how much? Fixed cost equal 400,000. Fixed cost 400,000. Then so we have to take actual capacity or normal capacity. Actual capacity or normal capacity? We have to get the fixed cost absorption rate per unit. We have to take normal capacity or actual capacity here.
Normal capacity.
Normal capacity, because the actual production is low, below than
The normal production.
capacity, right? Fixed cost, now we can find how we can charge here. We have to charge fixed cost per unit into actual production, isn't it? Here, the figure
So
should be here.
we can directly take 87% of 400,000.
Yeah.
Yes.
Here we can take this value of 87%. Then fixed overhead, how much? 348,000. So balance will goes to where? 400,000 minus 348,000 will charged in where? PL, right? Now here we will find total variable cost equal sum right, and total production cost equal total variable cost plus total fixed overhead equal total production cost. Total production cost. From these, right, from this what we can find? Total production cost plus total production cost plus closing stock equal total cost for the period, isn't it? Total cost equal cost of sales plus closing stock, right? Got the idea? Total cost, this value, cost of sales, this value, then how much? Sorry. Then how much cost of sales? Right? Got the idea? So this figure equals cost of sales plus closing stock, right? Now from the cost of sales, right, from the cost of sales, so we know that the production quantity, the quantity of sales, how much? 76,000 units. Then cost of sales equal this value. The rent, then cost per unit. Cost per unit, how much? Cost per unit, how much?
COS divided by quantity of sales.
Right, how much? 16. Right, 16. And closing stock equal 176,000. We know cost. We know the cost. How much cost? Cost per unit equal 16. Then number of units. Cost of value minus divided by the cost. How many units? 11,000. Then total production units equal sales plus closing stock. Sales equal 76,000. Closing stock equal 17,000. Then total, how many units? $87, right? This is actual production, isn't it? Actual production. Normal capacity, we know that this 87,000 equal to 0.87. Then only 100,000. Normal capacity is 100,000. Am I answer your questions? Right. Actual unit of production. How many? Actual unit of production?
87,000.
Right. Normal capacity?
100,000, sir.
Cost per unit?
16 rupees.
Right. Am I answer your questions? Make it clear? Make sense? Does it make sense? Any doubt you can ask. If you have anything to ask, I will explain. Right? So what's the answer? Right. So if you want, I can share this slide. Yes, I can upload this Excel. Then we can. Right. Right. Now we move to the next. Right. Systematic allocation of fixed and variable production overheads. Systematic allocation. So you might study about joint product, byproduct in process costing. Have you studied process costing in cost accounting? Have you studied? So in case of joint product means in a single process, in a single production process, more than one output, two or more main products, two or more main products are produced. That is a that is the what joint products. For example, in petroleum production, so when they process the petroleum, so they can take output as petrol, diesel, gasoline, like that kind of products, super petrol. So and at end of the production process, there are so many items, more than one item, valuable items, right? So there are so byproduct. Byproduct mean spares, spare like tar in the production, petroleum production, the wastage, tar and wax. So the byproducts mean this is the output, but in terms of the value of the product is very small, negligible, immaterial production. In the sawmill, we can find what that small piece of woods. So that is the by sorry that is the byproduct, not joint product. Right. In case of joint product, a production process may result in more than one product being produced simultaneously. So this is the case, for example, when joint products are produced, when the cost of conversion of each product are not separately identifiable, they are allocated between the product on rational and consistent basis. I hope you have studied how to account, how to find the joint, how to find the joint cost of the production process. So allocation may be used, for example, on the relative sales value basis of each product, either at the stage in the production process when the product becomes separately identifiable or at the completion of production. So here we mention relative sales of product. Sometimes it may take a number of unit basis or net realizable value basis. So it may be in the point of split, a point of separation, or it can be sell after the further process. Split of point, you might study that kind of technical terms in the cost accounting. Cost accounting, especially process cost accounting. In the case of main product and byproduct mean what? The wastages. So most byproducts by their nature are immaterials. So no, the value of that byproduct are not significant, not important, wastage, immaterial, right? When this is the case, they are often measured at net realizable value, and this net realizable value is deducted from the cost of main product. Cost of main product. So, for example, you produced an item X is the main item. The cost of the main item is 200 rupees. So there is some wastage. So the net realizable value of the waste is 10 rupees. Now the cost of the main product is 200 minus 10 equal 190 rupees. That's simple, right? The net cost of conversion, that is the cost of conversion reduced by net realizable value of byproduct. So value of the product, main product minus net realizable value of byproduct. So will be distributed among the main products. As a result, carrying amount of the main product is not materially different from its cost. So there's an illustration, right? Right, you can find, right, the illustration. I I have uploaded the answer in the slide notes, right? When you go to the slide view, you can find the answer. Right? It's your further reading. It's very easy, right? So it's also a little bit tricky, but here what you have to deal with fixed production overhead is give us 100,000. Here there are two products, two joint product, delta and beta. Here the normal capacities differ. So you can do this. Here normal capacity is 12,000. Here 10,000. Here 5,000. Here 5,000. Here there is no issue here, but here you may face a critical issue here, how to proportionate uh, the production of it. So that's the issue. So we can discuss with among you. And here other cost of inventories. So other costs are included in the cost of inventories only to the extent that they are incurred in bringing the inventories to their present location or present condition. So for example, it may be appropriate to include non-production overhead or the cost of designing products for specific customer in the cost of inventories. So cost excluded from the cost of inventories. Examples of cost excluded from the cost of inventories and recognized as expense in the period in which they are incurred. Abnormal amount of wastage material. So you might study abnormal loss, abnormal gain. So that abnormal loss and abnormal gains are not included here. Abnormal amount of wasted materials, labor, or other production costs. So storage costs unless those costs are necessary in the production process before a further production stage. Administrative overheads that do not contribute to the bringing inventories to their present location and condition. Selling and distribution cost, interest and borrowing cost. So it's LKAS about 23. So you just go through and you can find the basic idea. Right, so the answer is given, right? So that's all about the presentation.